Hello, greetings, and welcome to Dividend Blasters. This is our 23rd video. Topic today is my dividend growth and yield portfolio. Yep, I'm going to talk about it. Tell you what I got in there, what makes it up, and what are my next steps. So this is my taxable account. This is the account that I manage my own investments. Does not include my IRAs, and I got a handful of them. One that is managed by a professional services company, a professional financial advisor, and they've been doing it for me for more than 20 years. And it's been rolled over several times from previous employers. Typically, when I go from one job to another job, I take the 401k and I roll it into this one. So they're the professional management company, and they do that for me. I do have some self-directed IRAs where I am actually managing, or making the decisions on how to allocate those dollars. Those are again, they're tax deferred, but I self-direct those. One of which is a precious metals IRA. The other one is a crypto IRA. But anyway, that's for another video. Today, we're going to talk about my taxable account, and it's mostly dominated by dividend growth and dividend yield stocks. I have 33 holdings. They cross 9 major sectors. The current dividend yield on cost for these holdings is 3.99%. So it's not bad. Again, this is just my tax deferred account. Doesn't include my retirement. All right, next one. Before I go on, quick disclaimer. I'm not a financial advisor. Purpose of this video is for information and education. It reflects my own personal opinion. So please do your own research. Consult a financial advisor prior to making any decisions. Now, having said that, I've been investing for the better part of 30 years, a little bit more actually. And it's a passion of mine. I especially love to invest in dividend generating investments. I love cash flow. It's a passion, and I want to share it with you. So this you've seen before. This is my monthly dividend calendar by ticker symbol. And really what this shows is which investment is going to pay out a dividend when. So what's new about this from the last time is I am actually back into Realty Income. I've got back in to ticker symbol O and ticker symbol AMT. They're both REITs. One is a retail REIT, and it's the monthly dividend company, and you can see they pay monthly. And the other one is a specialty REIT focusing on cell towers, AMT, American Tower. And then we have JEPI. It's the ETF, and they're special. They pay monthly, but they also generate very high dividend payments, and they do that through investing in great dividend companies, but also selling options, and that's how they're able to pay those wonderful dividends, as does JEPQ. I want to say one thing about these covered call ETFs, JEPI and JEPQ. They're wonderful. I love them. But just make sure you understand that when tax time comes around, those dividends are going to be taxed as ordinary dividends. They are not qualified dividends. At least the part of those dividends that are generated by option selling that JEPI and JEPQ generate. So that could be 75 or 80% of your dividends from them. You will pay at a higher tax rate. So you should be aware of that. And then with the REITs, again, those are ordinary dividends. They're not qualified dividends. You will pay tax on those at a higher rate. So it's good to know. Doesn't mean you shouldn't invest in them. I invest in them. I love them. But I'm prepared to pay that, as should you if you want to do that. Okay, and then we have Horizon Technology. Well, wait, I just skipped over. I'm sorry. Then in the next row, we have Altria, ticker symbol MO in January, AbbVie, ABBV in February, and Chevron, CVX in March. and then it picks up again April, May, June, then July, August, September. And then you go to the next row, you have JEPQ. I talked about them. They're JEPI's little brother. Their focus is more on NASDAQ stocks, whereas JEPI's is not NASDAQ. It's S&P 500, if you will. There's a little bit of a crossover there. And then in the next row, after JEPQ, we have Horizon, Technology Business Finance, ticker symbol HRZN. That is a business development company, a finance company that provides financial backing for tech startup companies. And that is a small cap stock. You may be a little bit skittish about going into a small tech financial firm, given the recent banking crisis, and it's really mostly regional banks. I feel comfortable with this one. I have a small holding in it, and anyway, I'm watching it closely. I think they're pretty reliable, but I'm watching them. And now I do have several holdings in the large cap banking sector. I'm going to get to that. Like next, J.P. Morgan Chase, JPM. That's going to pay in January, April, July, and September. And then actually, if you go, let me skip down to the next row. We have American Express and Visa, AXP and V, both big credit card companies. They're in the financial sector, if you will. A little bit different than J.P. Morgan. But you know what I love about American Express and Visa? We use our credit cards in this country, and we probably do it a little too much. But every time somebody makes a charge, it is just helping to build our dividend snowball. So that's a thing of beauty. I personally have tried to get away from charging, and I've had my issues with credit cards in the past. I like to use my debit card these days. But anyway, and it's a Visa debit card. But anyway, I'm digressing a little. Let's go back up one row. So then in February we have Verizon, ticker symbol VZ. And then in March, we have T. Rowe Price, mid-size, large investment company headquartered in Baltimore, Maryland. And that's January, February, March. And then it picks up again, April, May, June, and then July, August, September. So those three firms are taking care of me every other month, as are Altria, AbbVie, and Chevron. And then to go down two rows below, we have Coterra Energy in March, June, September, and December. ConocoPhillips, and then Devon Energy as well, right below. I want to mention the little blue box, Activision Blizzard. They're a communications/entertainment company. They're a gaming company, and they've been in the news a lot, as you know. Microsoft is looking to buy them and acquire them in whole. They're getting some resistance from some of the regulatory authorities in the United States, like our Department of Justice, and authorities in the United Kingdom and in the European Union. So we'll wait and see how that shakes out. But let me go back to the three oil companies, Coterra Energy, ConocoPhillips, and Devon. I really like these companies. Now, even though the price of a barrel of oil has come down, these companies are cash machines, very much like the Visas and the American Expresses. And what I like about them, and they stand alone, is that these companies have so much cash, they have adopted the practice of paying special dividends. So, for instance, for ConocoPhillips, for first quarter of this year, I've already received my first quarter dividend, and I've also received a first quarter special dividend. So in first quarter, I've got two dividends that come from them. Now, I'm expecting that for each of these. So I will expect to get 8 dividend payments from ConocoPhillips. I'd say maybe 6 from Devon, maybe 6 from Coterra Energy. They're cash machines. And, the price is pretty decent for all of them. Conoco has a bigger market cap than the other two, and they're a little bit pricier, but very reasonable. All right, and then moving down, we have a bunch of stocks that pay in March, June, September, and December. So we have Bank of America, the big bank, Johnson and Johnson, Pfizer. We have the ETF, Schwab Dividend. Then we have the business development company, Ares Capital. Ares is a wonderful BD company. Not expensive, nice dividend. I'm always a little bit skittish sometimes about some of the BD or the business development companies. They got very high dividends. They're very cheap. So I'm very picky about the ones that I choose. And I've owned several of them in the past and ended up selling them. But I do like this one, and I've had this one for a while, and I'm holding on to it. And then the next one is an energy royalty company. It's called Kimball Royalty Partners, KRP, and they invest in oil and gas royalties. This is a fairly decent investment. It's cheap and it's lucrative if you're an investor. I pick up several hundred shares, typically for around $15. That's really where it hovers, and I can expect a dividend of about $2 a share. And I'm going to do another video on this because it really merits a deeper dive to talk about the tax treatments of master limited partnerships. And they don't call it a dividend, even though it is a dividend. They call it a partner distribution. And it does add up. It's pretty cool. Anyway, next one, Lockheed Martin, the big defense contractor. It's fairly pricey stock, $485 a share. Get about $12 dividend annually, $3 a quarter. Microsoft, we all know about Microsoft. I tell you, you know what? I love Microsoft. It is, again, in my judgment, it's a company on the move. I mentioned that they are looking to acquire Activision Blizzard. They're also a investor in OpenAI, ChatGPT, and OpenAI actually, it's the name of the company. ChatGPT is the product, but OpenAI is in private equity right now, and they're looking to go public. So I'm looking at them. I think that Microsoft is looking to continue to evolve. And, it's interesting to see the dynamics here. ChatGPT is a huge threat to Google. It'll be interesting to see how Google responds to this. Do a little research on ChatGPT. It's like doing an internet search on steroids. You do a search on ChatGPT and you get a very personalized answer. It's really quite remarkable. Let's go to next one is Raytheon, ticker symbol RTX. I like Raytheon. Raytheon is, if you don't feel like putting out the dollars to buy a Lockheed Martin or a Northrop Grumman, which are in the $500 and $600 range, Raytheon is a great defense contractor. Hovers at around $100, decent dividend. And then the last two are Valero Energy. I haven't really mentioned Valero. That's a good energy company that pays multiple dividends, and they will pay special dividends. And then Intel. And I got a little story about Intel. I used to own several hundred shares of Intel. I own 8 now. I sold most of them off last year. I have 8 that I can't sell because I can't find the certificates. 8 of my shares were certificated, and you can't sell them if you can't find the certificates. I could replace them, but I don't feel like buying new certificates. It's probably not worth it. So I'm going to just hold on to those 8 shares. But interestingly, I've noticed that the price of Intel has been actually going up, even though they did slash their dividend last month by 65%. Nobody was really surprised by that. But anyway, that's my dividend calendar in a nutshell. I'm going to go a little quicker. This here is really just the same thing, except it doesn't show the ticker symbol. It shows the holding by sector and subsector. So just first row is realty income. The sector is real estate. The subsector is our realty REITs. It's a large cap stock. You can look at this at your leisure if you like. Now, this here, you've seen this before. This shows the dividend per share that I get for each share of my holdings. And I like to monitor this. The reason why I have this is I can track changes to the dividend. So especially when we go into a new year, and if a company is a dividend growth company, I want to see that dividend yield and dollar amount go up each and every year. And I want to be able to track it by month. And that's the purpose of this. So I can do a comparison from one year to the next, 1 month to the next. Okay, so realty income is going up. Went up from 25.5 cents to 27 cents next year, something like that. So that's why I do this. Now, this here is a little bit more detail. I'm showing the ticker symbol, the name, the sector and subsector. And then the last three columns are really interesting. I'm showing you the percentage that each holding holds within the total. Each holding holds within the total portfolio. And then I'm also showing the percentage of dividend income that holding will generate for me that I'm reinvesting over the total portfolio income. And again, I'm dripping 100%. Every dime dividend I get, I'm dripping back into my holdings as I continue to grow the snowball. And then what's really telling is the yield on cost. And recall that the yield on cost is basically the ratio of the dividend, the annual dividend payment that you receive, or that I'm receiving, over what I invested in the holding. So for instance, when you see something like, well, let's go down to Verizon. They're only taking up about 2% of my portfolio. They're fairly cheap. They're hovering a little under $40 a share. They account for about 3.48%, 3.5% of my portfolio income, yet the yield on cost is almost 6.5%. So that is a dividend. That tells you that that's a dividend yield investment. Low growth, okay, but high yield. And it really drives the point home when you look at something like Visa, which is a very different holding. Visa is a much more expensive stock, and it accounts for about 15.5% of my portfolio. They have a low yield. They will make up about a little more than 3% of my portfolio income, but the yield on cost is very low. It's less than 1% because the dividend is low. But what you don't see here is the dividend growth rate. And Visa has a wonderful dividend growth rate. I think it's over 15%. And you know what? Even though the yield is less than Verizon, the growth rate is huge. It's much bigger. And the company's investment grows. The stock grows quicker. So I will expect that in 5 years, my dividend income coming from Visa is going to significantly outpace Verizon's. Verizon's there for another reason. It's steady dividend income. Visa's is going to be growing income, but it takes time. So that's the purpose of that. What you're also going to see is you're going to see that I have a lot of energy stocks. So I have Coterra Energy, I have Chevron in the first panel. I have in the second panel, I've got ConocoPhillips, Devon Energy, I've got Kimball Royalty Partners, and then in the third panel, I have Valero. And you know, I'm partial to energy stocks because they're cash machines. They pay wonderful dividends. Several of them pay special dividends. So as I said, I'm expecting to get more than 4 dividends from a couple of these holdings. Some of them I would expect to get 8. So that's why I invest in them, and I think that they're great, successful companies at making money. And that's really why we do this. We want to make money. I have a handful of healthcare stocks. So, for instance, let's take a look at in that first panel. I've got AbbVie. They take up about 13.5% of the portfolio, about 12.6 of my dividend income for the portfolio, and the yield on cost is about almost 3.7%. That sounds about right as far as the yield, the dividend yield, and then my yield on cost is about the same. It's been fairly constant. If you go, let's see, I want to find Pfizer and Johnson & Johnson. Where are they? Go to the next panel, Johnson & Johnson. Well, Johnson & Johnson is a little under 2% of the portfolio. Pfizer's a little under 0.6%. They make up less than 0.8% of dividend income, but the yield on cost is pretty high, particularly with Pfizer. Pfizer pays a decent dividend yield, and the price is very affordable. They're hovering for around $40 a share. Johnson & Johnson's been kind of, just kind of going sideways. They're around 150, I believe. So they're a little bit pricier, but they're a dividend king. And I like them because I own everything in my bathroom is generated by Johnson & Johnson. So I know they are very good at turning a profit. So anyway, let's take a look at, I talked about financials. So I talked about Visa and American Express. Visa, yeah, I already talked about that. So let's move on. Did I talk about JP Morgan and Bank of America here? I don't think I did. Let's take a look at Bank of America, and I'm looking at the panel. Second panel, Bank of America, about 0.5% of my portfolio, 0.3% of portfolio income. Yield on cost is 2.19%. So the yield is not bad for the price. The price is low. They're right around $28. They've actually lost some of their price value. I look at it as a buying opportunity. But one thing I'll just mention is that a couple things stand out here. Lockheed Martin is one of my largest holdings, about 20% of the portfolio value, 13% of dividend income. The yield on cost is about 2.5%. Lockheed Martin pays $12 a share per dividend, but you're going to pay $4.85 per share to get it. And you know what? If you want to go in fractionally, if your brokerage account lets you do that, I would recommend that because I think it's a wonderful company. They are front and center in maintaining our first line of defense. And I will also say the same thing about Raytheon. I'm looking also at Northrop Grumman. That's another good one. But anyway, I wanted to mention that. And then I also wanted to mention Kimball Royalty Partners, which is a company that invests in oil and gas royalties, and they pay wonderful dividends. So I buy several hundred shares at a time for $15 a share, and I can get $2 dividend per share. And it's actually like a master limited partnership. And they don't call them dividends, they call them distributions. And I'm actually going to do another video where I talk just about those type of investments, and I'll key in on KRP. I think it's a great investment. And you know what? I should mention that I have a handful of investments here, even though this is my dividend growth portfolio. I have a handful of what I'm going to call moonshots that don't pay dividends, but I have faith in them. Like I have SoFi Technologies, and I have Editus, which is very much into the CRISPR gene therapy and gene editing world. I'm expecting big things from them. And there's several other companies that I'm looking at in that world, like Beam and Caribou Biosciences and Pacific Biosciences. There's quite a few good ones there. It's just a matter of picking the right one. or at least not picking too many of the ones that aren't going to hit. So anyway, that's all I had on that slide. This here is more of a distilled view that shows the holdings by sector. So for instance, you can take a look at the percentage of portfolio value. And again, it's mostly dominated by my energy stocks, by my financials and industrials. And then when we get into the healthcare, it trails off. And the healthcare is mostly AbbVie, Johnson & Johnson, and Pfizer. The industrials is the Lockheed Martin and the Raytheon. Financials, JP Morgan Chase, Bank of America, Visa, American Express, and let's see, the energies, Chevron, ConocoPhillips, Valero, Coterra, Devon Energy. Those are the main ones. Consumer staples, it's really Altria. Altria, I didn't really mention, is a wonderful company. It's a tobacco company. Some folks won't invest in it. I get that. But they pay a wonderful dividend, and they have a wonderful dividend growth rate. Their payout ratio is a little bit high, but they've been paying it out for many, many, many years. And they also own Budweiser, so have a beer. You can see again what the percentage of portfolio income is. Most of my dividend income is coming from the energy stocks that I mentioned, and then it's the healthcare, and then the industrials, and the consumer staples, which is Altria, if you will. Yield on cost, by far my best yield on cost is the ETFs, and that's really being driven by JEPI and JEPQ and the option selling that those funds sell. It's very profitable for dividend investors. One thing you won't see with JEPI and JEPQ is a consistently growing dividend. It's going to fluctuate, but the dividends should be pretty good. So for instance, contrasting to my other ETF, SCHD, they've been growing their dividend consistently for 10 years. Now, their dividend is not as high as JEPI or JEPQ, but they don't sell options. They invest in the U.S. Dividend 100 Index. And they actually just reconstituted. So they did kick out a few companies like IBM, and they added a few. Like AbbVie, and AbbVie is now, and I mentioned AbbVie, it's the largest holding in SCHD. Let's see, energy is providing a good source of dividend income, and that's going to continue to grow, at least for the near term. Okay, let's move on. Now, what are the next steps for me? Well, I'm looking to build my positions across these different sectors. So ETFs, REITs, industrials, you can read them there. Now, the holdings are in yellow, are the ones that I already hold. So I'm looking to increase holdings in the yellow ones that are listed. The ones in blue are ones that I do not have, and I'm looking closely at them. So, I'm looking at the Vanguard High Dividend Yield Index Fund. I'm looking at the iShares Core Dividend ETF, DGROW. I'm looking at the Vanguard Dividend Appreciation Index, or VIG. I'm looking also broader than that. So not even just dividends, but I'm also looking at VT, which is Vanguard Total World Stock Index, and VOO, which is an index fund for the S&P 500. So those are in blue. And then in the REITs, I'm looking at Stag Industrial, and Vici Properties, and I haven't decided on those. I've actually owned Stag before, and I sold it, but I think it's a great company, but I like Realty Income a little better. Vici, I'm still investigating. It's more of an entertainment REIT, if you will. The industrials, I like Northrop Grumman. It's kind of pricey, but I'm looking at it. And you know what I really like? I like Waste Management. It seems that whenever I'm out and about in town, I'm driving around, a day does not go by that I don't see a waste management truck out there. And they have paid very good dividends. A little pricey, but not bad. I think they're hovering around $200. So I'm looking closely at it. I'm also looking closely at Costco. Costco's a little bit pricey. I believe they're around $500 a share, if I'm right. And I'm also looking at Lowe's, ticker symbol LOW. Um, so I'm really, I would say of the ones that I've just covered, Lowe's, Costco, and Waste Management are ones that I'm really um, focusing on, like a laser beam. The others are more nice to have. And then I like Medtronic, MDT, which is the medical equipment company. And then going down, and I'm really just focusing on the blues in IT. Although let me just mention Microsoft. I am making a concerted effort to build my position in Microsoft because the dividend yield is modest. The dividend growth rate is fantastic, but also the growth potential of Microsoft is huge, and it's a huge company. It's a $2 trillion market cap company. It's the second largest in the world after Apple, but I think their best days are ahead of them. And then I'm also looking at Broadcom, AVGO, and AMD and NVIDIA and Texas Instruments. And I would say that those last three are kind of more nice to have. I'm really intent on getting Microsoft, growing it. I have Microsoft, but I want to grow it a little bit. That's kind of my next steps. And that's really all I have. So I hope you found this informative and useful. And I would ask you to smash the like button and smash that subscribe button and share it with a friend. Have a wonderful day, and God bless.